Welcome to Economic Crossroads, the program that cuts through the noise to deliver a deeper understanding of Australia's financial landscape. Tonight, we dissect the profound shifts reshaping our economy, from the ebb and flow of property values to the evolving role of superannuation in the lives of everyday Australians. We'll explore the intricate dance between global pressures and domestic policy, and the human stories behind the statistics. Australia, often described as the lucky country, has for decades enjoyed remarkable economic stability, underpinned by strong resource exports and a robust housing market. However, recent years have introduced a new layer of complexity, driven primarily by persistent inflationary pressures and a subsequent cycle of interest rate adjustments by the Reserve Bank of Australia. The implications are far-reaching, touching every household and every investment portfolio.
Adam, the data indicates a significant rebalancing. Following a period of exceptionally low interest rates designed to stimulate the economy, we've observed a pronounced pivot. The RBA's cash rate target, which had lingered near historic lows, has seen a series of upward movements directly impacting the cost of borrowing for both businesses and households. This policy shift is a direct response to inflation, which, while showing signs of moderating, remains above the RBA's target band.
That's right, Ben. The RBA's mandate is clear: MNTN price stability and contribute to the welfare of the Australian people. The previous accommodative stance was appropriate for its time, but the confluence of supply chain disruptions, elevated energy prices, and strong domestic demand created an environment necessitating a more restrictive monetary policy. The bank's communications have consistently highlighted the need to manage inflationary expectations to prevent them from becoming entrenched.
Entrenched expectations. It sounds so clinical when you're living it. For many families, these shifts aren't theoretical. They're immediate, tangible financial hits. Think about Sarah and Mark, both in their early 30s, working as a primary school teacher and an IT support specialist, respectively, who bought a modest $750,000 townhouse in Brisbane's outer suburbs just 2 years ago. Their initial mortgage repayments were manageable, factoring in childcare for their 2 young children. But with each RBA interest rate adjustment, their monthly outlay escalated. One recent hike alone, adding 25 basis points, meant an additional $350 coming out of their bank account every single month. That's not a hypothetical number. That's $350 less for groceries, less for petrol, less for their kids' swimming lessons. It forces difficult choices. Do they cut back on fresh produce or delay a much-needed car service? It impacts their quality of life directly.
Chloe's example starkly illustrates the ripple effect. The property market, once a bastion of wealth creation for many, is now a focal point of financial anxiety for a significant segment of the population. While median dwelling prices across major capital cities saw unprecedented appreciation during the pandemic, the subsequent tightening cycle has introduced a period of rebalancing. This isn't a uniform experience. Some areas retain strength, while others experience more pronounced adjustments. To truly grasp the current situation, we must look beyond the immediate headlines and delve into the underlying structural drivers shaping our economic reality. These include demographic shifts, supply-side constraints, and the evolving dynamics of Australia's superannuation system.
Indeed, Adam. On the demographic front, Australia's population growth, largely driven by migration, creates persistent demand for housing. While net overseas migration experienced a temporary dip during global events, it has since rebounded strongly, placing renewed pressure on an already constrained housing supply. Our modeling shows that even with increased construction, the current rate of new dwelling completions struggles to keep pace with population expansion, particularly in key urban centers.
From a policy perspective, this isn't a new challenge. Governments, both federal and state, have grappled with housing supply for years. Zoning regulations, planning complexities, and the sheer cost of materials and labor contribute to a slower and more expensive development pipeline than is ideal. These are systemic issues that require coordinated, long-term strategies, not quick fixes. The market mechanism alone isn't sufficient to address these entrenched supply-side rigidities.
Systemic issues translate to everyday struggle. Consider Liam, a 26-year-old barista in Melbourne, working 2 jobs, trying to save for a deposit. He earns around $65,000 a year, and with the median house price in Melbourne sitting at over $900,000, even a 20% deposit means saving $180,000. To achieve that, he'd need to save $1,500 every single month for 10 years, assuming prices didn't increase further and he had no other expenses. It feels insurmountable. And then there's the rental market. With increased demand and limited supply, Liam's rent for a basic share house room in Brunswick has risen by 15% in the last year, swallowing a larger portion of his already stretched income. This isn't just about financial numbers. It's about life choices being limited, about the diminishing prospect of stability for an entire generation.
This leads us to superannuation, a bedrock of Australia's retirement savings, which also faces its own set of evolving dynamics. The compulsory nature of super contributions has amassed a vast pool of capital, which plays a significant role in investment markets, from equities to infrastructure. However, the investment landscape for these funds is not immune to global or domestic economic fluctuations.
Absolutely. The sheer scale of Australia's superannuation assets, now exceeding $3.5 trillion, means that even minor shifts in asset values have substantial consequences. Diversified growth options, popular among younger members, often hold significant allocations to Australian and international equities alongside property and infrastructure. When interest rates rise, bond values typically decline, and there can be downward pressure on equity valuations as companies' borrowing costs increase, potentially impacting future earnings.
The regulatory environment for superannuation is robust, designed to protect member interests and promote long-term stability. Recent legislative changes, such as the Your Future, Your Super Performance test, aim to weed out underperforming funds, ensuring that members' retirement savings are actively working for them. However, these measures also underscore the ongoing scrutiny funds face in delivering consistent returns amidst fluctuating market conditions.
The conversation often highlights a perceived divergence between the institutional view of economic health and the lived experience of the average Australian. While official statistics may point to resilience, the DLOI struggle of budgeting and managing debt tells a different story for many.
From a macroeconomic perspective, Australia's headline unemployment rate remains remarkably low, and GDP figures indicate continued, albeit moderate, economic expansion. These are strong indicators of underlying economic robustness when viewed in isolation. Corporate profits have generally held up, and export volumes remain solid, particularly in the resources sector.
And the RBA, in its statements, often points to these aggregate strengths, alongside the gradual return of inflation towards the target band, as evidence that their policy adjustments are having the intended effect. They also monitor household savings rates and debt-to-income ratios carefully, acknowledging that while some households are highly leveraged, the aggregate picture shows some buffers. The challenge for monetary policy is its broad-brush nature. It impacts everyone, regardless of their individual financial circumstances.
That's precisely where the rubber meets the road. These aggregate statistics feel very distant when you're facing your personal financial reality. Take Maria, a single mother working as a registered nurse in Perth, earning a respectable $90,000 a year. She purchased a $600,000 unit near the hospital 5 years ago. When rates were low, her mortgage was comfortable, allowing her to save a little and provide for her child. Now, with multiple interest rate adjustments, her monthly mortgage payment has climbed by almost $1,100 from its initial level. That's over $13,000 a year in additional mortgage interest, money that has to come from somewhere. She's had to cut back drastically. No more after-school tutoring for her child, fewer shifts for her elderly mother's care, and delaying essential home maintenance. Meanwhile, her superannuation balance, which she diligently checks, has seen some fluctuations due to market rebalancing, causing further concern for her retirement planning. It's not about economic collapse. It's about a steady, relentless erosion of discretionary income and future security for people who are doing everything right. They're working hard, managing their finances, but are caught in a current they can't control.
Chloe's insight underscores the crucial need to look beyond the averages. the distribution of economic impacts is rarely uniform, creating pockets of significant pressure even amidst overall stability. This divergence asks questions about the long-term social and economic cohesion of our nation. As we navigate these complex shifts, the natural question is, what does the future hold? Forecasting is inherently challenging, but by examining the current trajectories and potential policy responses, we can project possible pathways for the Australian economy.
Looking ahead, the immediate focus rests on inflation and the RBA's trajectory. While inflation shows signs of easing, it's a gradual process. We anticipate a period where interest rates stabilize, potentially followed by measured adjustments if inflationary pressures recede sustainably within the target band. However, the global economic environment, particularly developments in major trading partners and commodity markets, will continue to exert significant influence.
From the RBA's vantage point, the data dependency remains paramount. The bank will continue to assess incoming information on inflation, employment, wages, and global economic conditions. There is a clear commitment to bringing inflation under control while simultaneously seeking to preserve the GNS in the labor market. It's a delicate balancing act. We can also expect ongoing discussions around macroprudential policies, particularly if housing market conditions were to experience another period of rapid expansion or significant systemic imbalance.
For people like Sarah, Mark, Liam, and Maria, the hope is for predictability, for a period of stability where they can re-establish their budgets and plan without constant financial shocks. Young families need to know if they can afford to continue paying their mortgage, or if they'll be forced to sell their family home. Aspiring homeowners are looking for signs that saving a deposit isn't a perpetually moving target. And those relying on their superannuation, like a soon-to-retire couple in their late 60s in Adele Day, who have diligently contributed their entire working lives, are watching their balances closely, hoping for consistent, positive returns to secure their golden years. They're not looking for speculation. They're looking for security and the ability to plan their lives with confidence.
Chloe hits on a fundamental point. The economy is ultimately about people. The shift we're witnessing is more than just numbers on a spreadsheet. It's a recalibration of what's possible for millions of Australians. The period of rapid expansion in CRTN asset classes has given way to a more measured environment, one where careful financial planning and resilience are increasingly vital. Understanding these dynamics, the interplay of policy and lived experience, is crucial for all Australians navigating this new economic landscape. Join us next time on Economic Crossroads as we continue to explore the forces shaping our financial future. Good night.